Hey guys, I'm making this video because sometimes people have trouble with the statement of cash flows, and it seems kind of confusing initially, but after you take a little time to think about it, and hopefully after this video it'll make a little bit more sense to you. So the statement of cash flows is one of the four core financial statements that a company needs to prepare in order to make its operations and cash inflows and outflows, make that information readily available to the users of the financial information. And so this one does not have to be prepared in the same order as the other ones. With the first three we prepare, as you remember, the income statement, then the statement of retained earnings, and then lastly the balance sheet. Basically what the statement of cash flows does is it shows us how we got from the cash account balance on one balance sheet to how we got to that balance on the next balance sheet the next year. So basically, let's say you had $100 in your checking account on December 31st, 2015, and on December 31st, 2016, let's say maybe you had $125. So the statement of cash flow's purpose is to show how we got from the cash balance on one balance sheet date to how we got to it the next balance sheet date. And so it helps address some of these questions that you see listed here on the screen. Feel free to pause any of these slides at any point if you need to take a little bit more time to look into things and get your head wrapped around. Okay, so let's talk about the first of the three sections. So there's three sections. There's the operating, the investing, and the financing. So the operating cash, the section of the statement of cash flows related to operations is basically going to show cash that comes in and goes out with a direct relationship to our core operation. So this would be if we were a shoe manufacturer, the inflows would be from sales of shoes, the cash outflows would be for things such as paying employees, wages, paying office, rent, anything like that. So as this here on the screen, it says cash from operating activities is generally linked to those transactions and events that enter into the determination of income. So now remember, when we prepare our financial statements, we're basing them on the accrual-based system of accounting. So we record revenues and expenses when they are incurred, not when the cash is paid. So when we earn the revenue, we record it. When we incur an expense, then that's when we record it. So kind of the purpose of the statement of cash flows is to, we acknowledge that we use the accrual-based accounting system, but this is kind of a check on that. And so this actually shows the actual amount of cash that came in and the actual amount of cash that went out, not on an accrual basis. So when we're looking at the income statement and balance sheet and statement of retained earnings, we understand that all of those were based on accrual-based accounting. But managers, if they wanted to, could find some ways to twist things. And by the fact that there's a statement of cash flows, it makes it harder for things to pass through. So this is a way for us to say, okay, on paper you can say you have this much or that much amount of net income based on the accrual accounting system, but what do you actually, how much cash did you actually receive? Because making sales is good, but eventually we want to make sure that the amount of cash that's coming in parallels those amount of sales in the long run. Okay, the investing section of the statement of cash flows is going to focus its attention on cash flows related to investing items. So that might be buying a fixed asset, selling a fixed asset, things like that. Intangible assets, we'll talk about those a little bit more lately, a little bit more later. But so that's basically what this section is, and it throws non-current assets up here, and we're going to talk more about those later. But those are things that are easily converted into cash, or things that are going to be consumed relatively quickly, and they're going to include things like inventory, cash, accounts receivable, things like that. And lastly, we are going to have our financing section of the statement of cash flows. And those those cash flows are ones that are going to impact the equity and debt of the business. So a good example of this, borrowing money either by issuing bonds into the open market. We'll talk more about that later. Selling ownership in the corporation, that's another example. And an outflow related to financing activities might be repayments of the amount borrowed. Things like that. Maybe dividend distributions to shareholders. That would be another example of a cash outflow in the financing section. Here is a summary slide that I put together of the things I just mentioned a second ago. And if you're having trouble with this section, you might want to do a screenshot and print that out. If you want to, just remember you can hit the Control Print Screen button and then paste that little feller into Word. And that's a good way to print things out if you're only using one monitor at home. It might help you with your homework as well. I know sometimes things in the book can be a little bit overwhelming when you first look at it, but the statement of cash flows is actually pretty simple. Maybe in my mind it might make sense to present this a little bit differently, but basically you're going to start out with the beginning amount of cash that you had at the beginning of the year. We're going to include any of the change of cash flows from operations. And you can forget about this part right now. This actually what we're talking about here, the statement of cash flows, there's a whole chapter on it at the end of your book, and it's really confusing stuff. It's a pretty complicated thing to prepare if you're doing it from scratch. We're just barely scratching the surface in this chapter. And actually the slides you're seeing here are ones that I use when I'm teaching a later chapter in another class. So anyways, you can kind of ignore this part. So basically we start out with whatever we have. Then we look and see what was our cash flows from operations change. We either had more cash than we brought in, or we have more cash that went out than we brought in. So we look at whatever number that is. We're going to either add or subtract that depending on whether the total ends up being a negative or positive. Same thing, we're going to look at all of the different investing activities. Maybe we purchased some equipment, maybe we sold some. We're going to lump all those numbers together and see if we have a positive or negative number. If we had a positive cash inflow, we're going to add it. If it was a negative cash inflow, well, we're going to subtract it out. We're going to do the same thing with the financing activities, and then we're going to add that to the beginning balance, and we're going to get our ending. So let's say we started out with $100 of beginning cash. We had a $50 outflow for operations, so that will put us down to 50. Then let's say we had cash inflows of 10, so that will bring us up to 60. Cash outflows from financing, let's say that was 20, so that leaves us with 40. So basically we take our beginning balance, we're going to add all these to them, or subtract if it's a negative, and then that's going to give us our ending cash balance. Pretty easy, huh? And you can forget about this right now as well. Okay, so now let us take a look here at, this is the ebook I've pulled up here. And let's take a look here at how these financial statements are all interrelated. So notice here our income statement links in with the statement of retained earnings. That, of course, then links its way into the balance sheet. Okay? So we have to prepare those three in order. This one we don't really, okay? And this first chapter we're starting out at the very beginning of an accounting period. So we can see here this is the end of the first month. So really, it doesn't show you this, but really we're starting out with a beginning balance of 0. We had a positive amount of $2,900 that came in from us just performing the typical duties that we do as a Net Solutions business. We had a cash outflow for the purchase of land, and then we had cash inflows for that we got from selling stock. So this is basically what happened. I know that sometimes when you look at all the details on the screen, it can get pretty overwhelming, and this form is kind of confusing to follow. But this is the gist of what's going on, and my concern is more that you understand the mechanics than the way things are plotted out and formatted on a sheet of paper. Okay, so the beginning balance, we're starting out with 0 because this is the very first month that we've been in business. We have a positive inflow of $2,900 from operations, an outflow, a net outflow, meaning when we put the positive and numbers together for investing was negative, and $23,000 was from financing. So we went from 0 to $5,900. This was the first year. That's all you need to know as to how that works. But let's say here, for argument's sake, let me copy this over here, and let's just pretend, this is not in the problem or the book or anything anywhere, but let's just pretend that in the next year our outflows from operations. I'm just going to throw a number up there. Let's say we had a bad year and it was negative $3,000. Let's say that our investing, let's say we sold some of that that equipment. It was $15,000. Then let's say our financing was negative $1,000. Perhaps we paid some dividends or something like that. Okay, so let me go on and make this a little bit larger. I think I used 20 font for the others. Okay, so if this is what actually took place during the accounting period, okay, so here our beginning balance was 0. At the end of year 1, it was $5,900. So what was the end of one year becomes the beginning of the next year. So I want to say equals this, right? Boom. I forgot to label this, so this would be our ending balance. Okay? So the ending balance from one year becomes the beginning of the next year. We work our way through, and our ending was 1,000 this year, and it's going to become the beginning for, let's say, if we had a year 3. So the same way, if you have money in your bank account on New Year's Eve, it's the ending amount at 11:59. Let's say you had $2,000 in your bank account at 11:59 in 2015. When it becomes 2016, you still have the same dollar amount. So the beginning of one year becomes the amount for the beginning of the next year. Now, notice that when we get to the end and we've prepared the statement of cash flows, this number needs to agree to what is on the balance sheet over here. We can't just have different numbers, right? This has to agree. We don't necessarily have to prepare one before the other, but these two figures on the financial statements are going to need to agree. And so this explains how we went from 0, what did we involve ourselves in, and how we got to this ending dollar amount. If you have any other questions, please let me know. Have a great day.